Hey guys, in today's video, we're going to quickly go over all of the ICT trading strategies. So without wasting any time, let's get started. Number 1. The Silver Bullet Trading Setup. The Silver Bullet is an ICT trading strategy that combines three main concepts: market structure shift, liquidity sweep, and fair value gap. To trade Silver Bullet, wait for the price to break above the day's high during the London or New York session, and then quickly return inside the range, taking out the buy-side liquidity. This liquidity sweep above the key structure of the day signals a possible upcoming reversal. Next, we wait for a bearish market structure shift to confirm this reversal. A bearish market structure shift happens when the price breaks and closes below the recent swing low. This shows that demand is no longer in control, and the price may start pushing to the downside. Then mark the bearish fair value gaps that formed along the way as supply zones. Set a sell limit order at the start of the FVG zone, and wait for the price to pull back to this area. If new FVGs form, you can plan future trades, but always follow a proper risk management plan. Similarly, in the bullish scenario, wait for the price to sweep liquidity below the day's low. A valid liquidity sweep pattern forms when the price breaks below a level, but immediately moves back inside the range. Next, wait for a market structure shift to confirm the reversal. Finally, mark the fair value gap and set up your trade. If there is only a small fair value gap, don't forget to use a slightly larger stop loss to protect your trade from market fluctuations. Number 2. Cameron's model. This trading model is made up of three main components: a draw on liquidity, stop rate, and entry. So, what is a draw on liquidity? It basically means finding a key liquidity level that the price is moving toward. In simple terms, the market often moves to areas with resting liquidity, such as equal highs, equal lows, or obvious swing highs and lows, because that is where many orders are waiting to be filled. So in the first step of Cameron's model, look for a key high or low on the 1 hour that the price is moving toward. As you can see here in this example, we have this swing high on the hourly chart, and the price is drawing up towards it. We can anticipate the price reaching this high, because that is where liquidity exists. If you can't find any draw on liquidity on 1 hour, you can zoom into the 15-minute chart. The next step is identifying a stop rate in the opposite direction of our draw on liquidity on the 5-minute chart. So let's switch to a lower time frame. Keep in mind that the liquidity zone is above us. Now, we are looking for a swing low to be taken out, which is called a stop rate. Finally, we look for fair value gap formations to set a buy limit. If you can't find any FVGs on the 5-minute chart, you can zoom into the 1-minute or even the 30-second chart. In the bearish scenario, simply find a key liquidity zone that the price is moving toward. Then zoom into the 5-minute chart and wait for a stop rate above a recent swing high. Find a fair value gap and set a sell limit at the start of the FVG, and place your stop loss above it. Don't forget to give the price some room to breathe, so don't keep your stop losses too tight. Number 3. Inversion fair value gap. For a quick reminder, a fair value gap, or FVG for short, is a 3-candlestick pattern where the first candle's low does not overlap with the third candle's high, or when the first candle's high does not overlap with the third candle's low. Now, what is an inversion FVG? An inversion is a failed fair value gap that gets disrespected by the market. For example, here we have a bullish imbalance that caused this FVG. When the price pulls back to this area, we expect a rejection to the upside and a continuation of the uptrend. But you can see that the next candles close over the FVG, completely disrespecting it and creating an inversion. Now we can place a sell limit and expect the price to either retrace back to this zone or move lower. Keep in mind that this method works much better when combined with other concepts. For example, if an inversion FVG occurs after touching a higher time frame key level or a higher time frame trend line, it has a higher chance of working out. Now, here's an extra tip to know whether an FVG is going to hold or fail. The midline of the FVG is very important. What I like to see with the midline is that the price comes down and respects this level, then moves higher. But if the price comes and violates this level, I can expect it to move lower, disrespect the fair value gap, and create an inversion. Number 4. Turtle Soup. The Turtle Soup setup is another trading model that combines the concepts of market direction, liquidity raid, and fair value gap entry. A high probability bullish Turtle Soup setup occurs when the price raids liquidity below a recent low, while resting above a bullish fair value gap. Similarly, a bearish turtle soup occurs when the price raids liquidity above a recent high, while resting below a bearish fair value gap. Now, how do we enter the market? As you can see here in this example, we have a clear uptrend, so we are only interested in buying opportunities. But where should we set our entry? This area of demand looks like a promising zone to place a buy limit. However, as smart money traders, we know that this area is where many retail traders will place their entries and set their stop losses just below. This means there is a high chance of manipulation at this level to target the sell side liquidity. If you also check the left-hand side, you can identify a fair value gap, which can be a great demand zone for entering a long position. To trade the turtle soup setup, we wait for the price to reach the liquidity below the swing low and show signs of rejection at the FVG. Once the price returns inside the range, we can open a buy position with our stop loss placed below the zone and target the next important level ahead of the market. Next, we have candle range theory. But before we continue, if you want to get a funded account quickly, check out Funded Next's new Stellar Instant plan, which does not require a challenge phase. That's right, you get instant access to trading capital from day one. There is no daily drawdown limit, no minimum trading days, and you can withdraw profits anytime. They also offer plenty of other plans, ranging from $5,000 to $200,000 accounts. And finally, some of the best offers if you are a futures trader. If that's something you're interested in, check out the link in the description. Number 5. Candle range theory. Candle range theory, or CRT, is a trading concept that focuses on the price range, high to low, of a single candlestick on the chart. The typical concept of this strategy usually involves 3 candles, and each candle has its own important role. The first candle defines the range. The second candle creates the sweep. The third candle provides the entry. Let's break this down step by step as a concept. Starting with the first candle, the candle range theory suggests that every candle's high and low act as the most important liquidity levels that the following candles will use as targets. If the second candle attacks the liquidity above the candle range high and immediately reverses, there's a high probability that the next target will be the liquidity below the candle range low. But how do we actually trade the CRT? In an uptrend, mark the high and low of a bearish candlestick during the correction phase. If the price breaks and closes below the low, we skip this setup and move to the next one. But if the price sweeps the liquidity and quickly returns back inside the range, then we have a valid CRT trading setup. Next, zoom into a lower time frame to find an entry. Look for bullish fair value gaps that form and set a buy limit. The stop loss should be placed below the zone, and the target will be the next important level ahead of the price. Keep in mind that you can use any time frame combination for this trading setup, but one of the most popular options is to use the 4-hour and 1-hour charts for the higher time frame, and the 5-minute or 15-minute charts for the lower time frame. Number 6. Optimal trade entry. The optimal trade entry, OTE, is a trading concept based on Fibonacci retracement levels that focuses on finding the best correction zone to trade. In a bullish scenario, we apply the Fibonacci levels from the start of the swing low to the recent swing high to find the best entry zone. Several important Fibonacci levels will appear on the right, but the optimal trade entry suggests that the zone between 0.786 and 0.618 is our best area to enter a trade. This is because of 3 main reasons. The first reason is a better risk-to-reward ratio. We know that wherever we enter the trade, our first target would be the previous high, because this is where liquidity usually rests and where the price is likely to reach, so this zone provides a higher risk-to-reward ratio. The second reason is safer stop-loss placement. We know that the safest place to set a stop-loss is below the swing low, so entering closer to this level allows for a smaller and safer stop-loss. The third reason is to avoid getting trapped. The market often takes out early buyers before moving higher, so there is a higher chance that early entries get stopped out. By waiting for deeper entries, we can avoid that liquidity hunt and join the real move to the upside. To enter the trade, simply place a buy limit at the middle of the OTE zone. Keep in mind that you might miss some trades when using this method because you are trading during deeper corrections. That's why this setup works best on assets that tend to have deep retracements, like gold. But remember, always combine this concept with other smart money ideas like market direction, supply and demand, or even a fair value gap within the OTE zone to provide a stronger trading signal. Number 7. Change in the state of delivery. The change in the state of delivery, or CISD, is a reversal pattern where the price momentum suddenly shifts direction. In this example, you can see a clear uptrend. The latest price action shows strong bullish momentum with a breakout and multiple fair value gaps. The market looks clearly bullish, and we expect the price to keep pushing upward after a short pullback. However, notice how the price suddenly drops with strong selling pressure, creating a bearish FVG. This condition is known as a change in the state of delivery. This sudden shift in momentum signals a possible reversal to the downside. To trade the CISD, wait for the price to return into the FVG and the inversion FVG overlap.